Looking for the best utilities ETFs to invest in? In today's exciting financial world, there's no shortage of investment opportunities, but if you're after something with a bit of stability in an ever-changing market, then exchange-traded funds, or ETFs as they're commonly known, might be the perfect solution for you. Particularly, we're shining a spotlight on the niche of utilities ETFs. Now you might be asking, why utilities? The answer is simple. To keep the world running smoothly, utilities are fundamental. They're the foundation that keeps our society functioning. We're not just talking about electricity and water, although they're critical components of the utilities sector. There's also telecommunications, natural gas, and even renewable energy. These elements are integral to our daily lives. Whether it's turning on a light, making a phone call, heating our homes, or powering our devices, we are constantly dependent on utilities. But it's not just about the practicality. The utilities sector is a beacon of resilience and stability in an often turbulent market. When other sectors are fluctuating wildly, utilities tend to remain steady. They're considered defensive stocks because they're less likely to be affected by economic downturns. This makes them an attractive option for long-term investors seeking a balance between growth and security. Investing in utilities ETFs means buying into a diversified collection of utility companies, which offers a level of protection that investing in individual stocks might not. It's like putting all your eggs in different baskets. If one company fails, your investment won't be completely lost. To summarize, if you're looking for a solid, reliable investment that can weather economic storms and still provide steady returns, utilities ETFs could be the answer. Today we're diving deep into the world of exchange-traded funds, specifically focusing on those related to utilities. To keep the economy running, utilities are essential, and this sector is known for its resilience and stability, even in turbulent market conditions. First on the list is the Utilities Select Sector SPDR Fund. A remarkable consideration within the world of ETFs, this particular fund has garnered significant attention from investors worldwide. With a large, diverse array of investors, ranging from the high-risk takers to the more conservative, this ETF offers a unique appeal for everyone, thanks to its robust attributes. Primarily, it is the broad exposure to the utilities sector that stands out. The utilities sector comprises companies providing essential services, such as electricity, gas, and water. As a result, this sector remains relatively stable, regardless of the economic climate, making investments in this ETF a safe bet. Interestingly, the stability of this sector reflects in the ETF's performance, offering a steady, if not spectacular, return on investment. A notable feature is the impressive yield. Fund consistently outperforms its benchmark index and delivers promising returns to its investors. Over the years, it has proved its mettle by providing consistently high dividends that have left its competition far behind. The steady stream of income derived from these dividends has made this fund a preferred choice among income-focused. It showcases a low expense ratio. This essentially means that the costs associated with managing the fund are relatively low. Therefore, a larger portion of the returns makes its way into the investors' pockets, creating a more favorable scenario for those who choose to invest in this fund. The low expense ratio is a testament to the efficient management of the fund, which can significantly enhance the overall profits. However, while it shines in numerous areas, it comes with its fair share of risks. The most prominent among them is its heavy weightage towards the top 10 holdings. This implies that a significant portion of the fund's assets are held in just a few companies, heavily leaning the performance of the fund towards these entities. While this strategy has its advantages, it may not be ideal for those seeking a more diversified portfolio. Next up is the Vanguard Utilities ETF. This exchange-traded fund has garnered a reputation among investors worldwide for being one of the most cost-effective methods to gain extensive exposure to the utilities sector, a crucial segment of the market that is often overlooked. The sector, comprising companies providing essential services such as electricity, water, and gas, is known for its stability. In a volatile market, having exposure to such a reliable sector can be a boon for risk-averse investors. And the Vanguard Utilities ETF is a gateway to this sector, which is often characterized as being resistant to economic downturns. This ETF stands out due to its impressively low expense ratio. In layman's terms, an expense ratio is what it costs an investment company to operate an ETF. A lower expense ratio means the fund operates at a lesser cost, which can translate into higher returns for investors. Vanguard Utilities ETF, with its low expense ratio, offers exactly that. an efficient, inexpensive way to invest in the sector. Moreover, this ETF is praised for its high liquidity. Liquidity, in the financial world, refers to how quickly an asset can be bought or sold without affecting its price. High liquidity ensures easy trading, meaning investors can quickly and conveniently buy or sell their holdings. The Vanguard Utilities ETF, therefore, provides not just affordability and exposure to the utilities sector, but also convenience and ease of trading. However, it's that it shares a similar characteristic with the Utilities Select Sector Spider Fund. It is somewhat top-heavy. This means it has a higher concentration of assets in a few top companies, which could make it more susceptible to their specific risks and performance. But despite this, the Vanguard Utilities ETF remains a popular choice. Known for its low expense ratio, this ETF is a cost-effective way to gain exposure to the utilities sector. It's also renowned for its high liquidity, ensuring easy trading. However, similar to the Utilities Select Sector Spider Fund, it is somewhat top-heavy. The third ETF to consider is the Fidelity MSCI Utilities Index ETF. As an essential part of the financial landscape, ETFs or exchange-traded funds are crucial to keep in mind when you're looking into broadening your investment portfolio. For those who may be unaware, ETFs are basket-like securities that track an index. Now, the Fidelity MSCI Utilities Index ETF in particular is a player to reckon with in the finance world. This fund provides spectrum exposure to the utilities sector, a segment of the industry that has its roots in various services such as electricity, gas, and water companies. These, as we know, are instrumental in the functioning of our everyday lives, making them an appealing investment area. But what sets the Fidelity MSCI Utilities Index ETF apart? Well, it's the fund's low expense ratio. The expense ratio is an essential factor to consider while investing, as it measures the total annual cost required to operate a fund. A lower expense ratio means less money is taken out of your investment, allowing for potentially higher returns. The Fidelity MSCI Utilities Index ETF boasts an attractively low expense ratio, making it a compelling choice. Nonetheless, there are no investments without their fair share of risks. One potential downside to this Fidelity MSCI Utilities Index ETF is its lower yield when compared to some other utilities ETFs. A lower yield might mean fewer profits for the investor. This, however, is a risk that investors may need to balance against the benefits provided by the low expense ratio. Despite this, the Fidelity MSCI Utilities Index ETF remains a strong contender in the field of utilities ETFs. The iShares US Utilities ETF is another noteworthy option. It offers substantial exposure to U.S. utilities companies, but its higher expense ratio compared to its peers might be a turnoff for some investors. Moving on, the Invesco DWA Utilities Momentum ETF is unique as it selects utilities stocks based on price momentum. This might be an attractive option for those looking for a more aggressive approach. However, it's worth noting that this strategy could lead to higher volatility. Other honorable mentions include the First Trust Utilities AlphaDex Fund, the Invesco S&P 500 Equal Weight Utilities ETF, the Spider S&P International Utilities Sector ETF, the John Hancock Multi-Factor Utilities ETF, and the Invesco Wilder Hill Clean Energy ETF. Each of these has its unique advantages and disadvantages, which should be carefully considered before making an investment. In summary, utilities ETFs can be a stable addition to your investment portfolio, providing regular dividends and potential growth. However, it's important to consider factors such as expense ratios, yields, and the fund's specific approach to selecting stocks. Remember, investing is not a one-size-fits-all endeavor. What works for one person might not work for another, so always do your due diligence and consider your risk tolerance before making any investment decisions. Enjoyed the video? Show your support by giving it a thumbs up. Want more insightful content like this? Subscribe to Caffeinated Money and get notified of our latest videos. And don't forget to drop a comment below and share your thoughts on your favorite utilities ETFs. Until next time, keep your investments brewing.